All right, today we are stepping into the CFO's office. We're going to talk about those massive, multi-million dollar decisions that can literally make or break a company. So imagine this. You're the one who has to approve a huge new project. Maybe it's a new factory or a whole new business line. On paper, the numbers look great, but how can you be absolutely sure? One wrong move here isn't just a little setback. It could be the very last mistake your business ever makes. To really get a handle on this kind of risk, we first need to understand where our money goes. And basically, it falls into two big buckets. You've got your day-to-day operational expenses, or OPEX, and then you have the massive long-term capital expenditures, which we call CAPEX. Now, here's what's so important to get about this slide. It's all about the scale of the mistake. Look, making a bad hire, that's an OPEX error. It's painful, for sure, it's costly, but you can eventually fix it. A bad CAPEX decision, though, like building a factory in the wrong location, that's a mistake that can haunt you for years, maybe even bring the whole company down. The stakes are just in a completely different league. So with stakes this high, you'd think every company would be using foolproof methods, right? Well, you'd be surprised. So many businesses rely on really simple metrics that are, frankly, dangerously flawed. Let's take a look at the two most common traps people fall into. First up is the payback period. And it's incredibly intuitive. You invest ₹1,000,000, and this calculation just tells you how many years it's going to take to get that million back. Simple. Faster is better. Seems totally logical, right? And then there's the other big one, the average rate of return. This one looks at the total profit you'll make over the entire life of the project, and it just gives you a percentage. A higher return? Well, that sounds like a no-brainer. But here's the problem. Here is the fatal flaw. Both of these methods, as easy as they are to calculate, are completely blind to a fundamental law of finance. They treat money you might earn 10 years from now exactly the same as cash in your hand today. And that, my friends, is a massive, costly oversight. And this brings us to the hero of our story today. This is the one concept that separates amateur guesswork from truly professional decision-making. It's called the time value of money. The time value of money is actually a really simple idea at its core. It just means that a rupee today is worth more than a rupee tomorrow. But why? Well, because the rupee you have right now can be put to work. It can be invested and start earning a return for you immediately. And this example just lays it out perfectly. If you have 100 rupees today, you can invest it, and at a 10% return, you'll have 110 rupees next year. So if someone offers to give you 100 rupees next year instead of today, what's really happening? You're actually losing out on that potential 10 rupees of growth. This is a core truth. Future money is always worth less than present money. Okay, so we've got this really powerful concept, but how do we actually apply it to that million-dollar decision? Well, we use the gold standard for evaluating major investments. It's a method called net present value, or NPV for short. The magic of the NPV method is that it does one absolutely critical thing. It takes all the money a project is expected to make in the future, and it translates every single rupee into what it's worth today. This lets us make a true apples-to-apples comparison with the money we have to spend right now. And don't worry, the process is actually pretty straightforward. It really boils down to 4 clear steps. First, we figure out our initial cost. Second, we forecast all the cash we think the project will bring in. Third, and this one is key, we choose something called a discount rate. And finally, we just run the numbers to find the NPV. Now, let's just pause on that third step for a second, because the discount rate, it's kind of the secret sauce here. The easiest way to think about it is as your minimum acceptable return. I mean, if you could put your money in a super safe fixed deposit and earn 10%, why on earth would you take a risk on a new project that earns you less? That 10% becomes your opportunity cost, and it's the perfect baseline to use as your discount rate. Okay, here's where the magic happens. Let's look at the table. In year 1, we expect to make 230,000 rupees. But when we apply our 10% discount rate, that future money is only worth about 209,000 in today's terms. See that? And then the money in year 2 gets discounted even more. We do this for every single year of the project and then add it all up. So that total future cash flow of over 1.3 million rupees, in today's money, it's actually worth just over 1 million. All right, we've done all the heavy lifting. We have translated the future into the present. Now, it is time to make the final call. So let's start with what it costs. Our project requires an initial investment, a cash outflow of 1 million rupees. That's the money going out the door today. And what do we get in return? Well, after we discounted all those future earnings, we figured out that the total present value of all our cash inflows is 1,014,118 rupees. And now for the moment of truth. We take the present value of what we'll get, and we subtract what it costs us today. And the result is a positive net present value of 14,118 rupees. That positive number, that is our green light. Now, this is probably the most important part to understand. A positive NPV doesn't just mean the project made a tiny profit of 14,000 rupees. No. It means the project will earn you your minimum required return of 10% plus an extra 14,118 rupees on top of that, all in today's money. It is a clear, undeniable win. So, the decision rule from here on out, it's beautifully simple. If the NPV is positive, the project earns more than your minimum, you do it. If it's negative, it doesn't even meet your basic expectations. You reject it. And if it's zero, well, it means the project earns exactly your minimum required return. And this actually brings us to a related idea you'll hear about called the internal rate of return, or IRR. Think of the IRR as the project's true inherent rate of return. It's the one discount rate that would make the NPV for this project exactly zero. So in our example, the IRR would be just a little bit higher than our 10% discount rate. So after all of this analysis, it all comes down to one simple, incredibly powerful thesis. If you want to make smart, multi-million-dollar investment decisions, you should always choose the projects that have a positive net present value. It is the single best rule there is to protect and to grow your capital. And by really understanding this, you've done way more than just learn a formula. You've moved beyond those simple, flawed metrics, and you've started looking at opportunities with the same discipline as a top-tier chief financial officer. So, congratulations, you are now equipped to make the kind of decisions that build real, lasting value.